Welcome back to the show. Let's talk to Connor Campbell. He is a financial analyst at Spreadex. We've got three stocks to talk about that are reporting this week. Let's kick off with KIER Group, the stock code KIE. Down 20% this year. What are your clients up to there?
Yeah, it's interesting. KIER Group, from a financial perspective, hasn't had too bad a year. I think in March, its half-year revenue was up 4%, interim dividend was up 5%, you know, decent figures. It spiked to an 18-month high in March, but that high really didn't last long, sort of basically the moment it hit it. And then has seen this, as you can see, a pretty substantial and consistent decline in the last few months. Most of that seems to be, I think, sort of sector-wide concerns in the construction sector, exacerbated by Carilion's, you know, mega fall. Basically, that's perhaps put the fear in some investors about being in the sector at the moment. In June, sort of a bit of bad news. It said it was taking a £73 million full-year hit as it sort of got rid of its Hong Kong and Caribbean businesses, but it still said it was on track for it to meet its underlying profit forecast, basically. So I wouldn't say there hasn't really been enough negative news to justify quite how sharply KIER has fallen, you know, in the last few months, and that's why we're seeing our clients buy around that £11 mark. You know, it's really hasn't seen any positive momentum at all. However, its full year figures this week, I think revenues expected to be up 4 or 5%. Whether that's enough to get investors on board, I'm not sure, but there is plenty of room for it to. Even if it moves back towards 11.50, that's a decent rise from given how poorly it's done in the last few months.
Understood. Let's move on to Capita Group, stock code CPI, up 21% this year. What's going on here?
Yeah, well, this looks like a fairly healthy chart. It has to be put into the context of exactly what it did last year. You know, it had an absolutely horrendous 2016, and even rising 20%, 21% this year at around 625. It's barely above half where it was at the start of 2016. So there's a long, long way to go before it is fully recovered. However, there are signs of a turnaround. Full year figures in March, they sort of still carried the stench of that awful 2016. I think pre-tax profit was down 33%, underlying pre-tax profit was down 19%. They were both far worse than even the December revisions that had taken the stock another leg lower. CEO Andy Parker announced his resignation, which again, you know, fair enough. I don't think he really could stay after the kind of year Capita had. However, heading into June, things started to turn around. It said that it had £318 million in extensions and new contracts and things like that. It was bidding on work worth £3.8 billion. It said it was seeing a turnaround in some of the sectors, I think like the property sectors and stuff that had dragged it lower earlier in the year. And the real coup that sent it higher in that June report was that it was in discussions with British Airways to take over their call centres. You know, that would be a fantastic move for Capita. It shows that big companies are still willing to work with the company, despite their issues. Since then, obviously, it's fallen lower. I think investors are going to want to see if that turnaround has continued. Obviously, any news on extensions and contracts and things like that. And I guess what will be key is update on a CEO search. I think Andy Parker left last Friday, is taken over by an interim boss, but there's been no news on any kind of permanent replacement. Any update on that, I think, will cheer up investors. Really, our clients have been buying around the 625 mark. I think they're looking for it to, you know, it's seen that slip, move back towards some of the levels where it was earlier in the year.
Understood. Let's wrap up with Mitchell & Butler, code MAB, flat on the year. What's your thoughts?
Yeah, it's flat on the year, but has seen sort of some absurd movements in the last couple of months. Mitchell & Butler, it owns Harvester, Toby Carvery, All Bar One, basically, you know, cheap food and drink establishments. In May, its interim update, really, really bad. Pre-tax profits were down nearly 10%. Obviously, that was the main catalyst for that huge fall. Other figures were okay. I think like-for-likes were up 1.6%. Overall sales were up 2.4%. As you can see, though, investors really weren't taken with that update. Cut to the end of July, and it jumped an absurd 18%. Basically on the news that like-for-like sales in the third quarter were up 2.6%, and it had sorted out some lingering pension issues. And obviously, 18% jump on that kind of, you know, decent but not particularly spectacular figures.
That was a fat finger.
Yeah, it was massive. And as you can see, the next day it then fell 11%, wiping out most of that growth.
Right.
But, and as you can see in May, you know, it has got the capability to see these sort of really wild swings. In terms of its figures on Thursday, investors are going to want to see that like-for-like growth in the third quarter wasn't a fluke, that it's continued into the fourth quarter. And they're going to want to see some kind of update on its full-year profit figures, given that, you know, it saw that huge 10% fall in half year. However, given the recent inflation and wage growth figures, I'm not really sure where where the good news is going to come from. The only point to say about Mitchells and Butlers is all the sort of the establishments it owns are on the cheaper end of things. So if there is sort of squeezed wages, if people are going to be going out to eat out, and that perhaps it stands a better chance of withstanding any sort of household spending drop.
And finally, clients.
Our clients are sort of selling around that 245 mark. Like I said, it's hard to see where the good news is going to come from given the recent figures in the UK.
Connor, brilliant stuff. Thank you very much.
Thanks very much.